Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the markets this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
Welcome back from more of your lovely holidays, John.
Thank you, they were excellent.
Well, I'm very glad to hear it. Right, John, listen, I know we want to talk about interest rates, we want to talk about the Fed, we want to talk about the UK, etc. But before we do anything, I want to bring you with me to look at the half-year report from Next, which is always really well written, always really interesting, and always focuses on stuff that everyone should be focusing on. And so there's everyone, I'm going to put the link in the show notes. Go to page 22 and start reading, because this is a bit where they look outside the performance of the company to look at wider trends in the economy. And they're looking at something you and I have talked about a lot, John. Where are the job vacancies going? Is AI affecting things? What is happening? So there's a chart, I'll pop it on Twitter for you, shows how the continued fall in UK vacancies is beginning to be reflected in the actual number of employed people. And those trends are echoed in Next's own data. They tell the same story. So vacancies at their stores are down 35%, more in some stores. And applications for jobs at Next have gone up by 76%. So applications per vacancy to work at Next are 2.7 times higher than they were 2 years ago. That's really something. Those are big numbers. And then you keep going down. I'm telling you, page 23 now, listeners, page 23, because I want you to go and look at this yourself. He then looks at it in terms of inflation. A decade of above inflation increases in the employment costs of entry-level work at or around the national living wage, something that's been compounded by the recent increase in employers' national insurance increases. So if you look at the chart, you can see that since 2015, inflation has gone up 38%. The national living wage has gone up 88%. And the cost of part-time employment, i.e. having someone work for 16 hours a week, has gone up 102%.
I'm not surprised by those figures, but it's extraordinary whenever you put it like that.
Yeah.
And you can also, it's also, I guess, I know he does mention AI, but it's pretty clear what the actual driver is. Yeah.
And what he says then is that mechanization will be driven by this. So the increase in costs is likely to have accelerated the rate at which businesses have mechanized. The effect of automating some work is mirrored and likely amplified by the potential for AI to improve the efficiency of many desk work activities. So you may say, and this is a conversation that you and I have had a lot over the years, that if you make labor more expensive, in some ways, this isn't a bad thing because it means that there will be a huge rise in productivity. So we'll have mechanization. AI will take over those boring, lowly paid clerical jobs. And that is in some ways a good thing. We'll have a more productive economy, except for if those people don't go on to be employed elsewhere. The fact that some people are more productive doesn't help the people who don't have a job at all.
Well, no, and also, obviously there's the knock-on impact on the benefits bill as well, because part of the problem with this, a lot of this messing about with the minimum wage was to offset the issues raised about people being in work and still having to get tax credits, which all goes back to Gordon Brown's kind of entire revamping of the UK economy for the worse. But the problem is if you then, as you say, if you don't have jobs for people to go into, if you're basically pricing people out of employment, then the entirety just ends up falling on the state. So I do think, and put it this way, I don't think the productivity gain was the driver for these changes, and I don't think it's going to be something that we get out of these changes for exactly the reasons you've just outlined.
Okay, deep sigh all round. And on from that, John and I, listeners, we do not have a solution to this problem. We are simply pointing out what is happening. If you make employing people more expensive, fewer people will be employed, and there are consequences. Are you listening, Rachel Reeves? Please, occasionally listen to us. We would really appreciate it. Anyway, this kind of thing makes life difficult for the Bank of England, though, of course, their mandate is not employment. It is inflation, but they found themselves in a situation where we have this increasingly obvious employment problem, but we also have inflation. So what did they do, John?
Well, they did exactly what everyone expected them to do. They've kept interest rates at 4%. The chances are very high now that there won't be another rate cut this year. The thing that everyone was keeping an eye on this time was quantitative tightening, which is the rate at which they're getting rid of the gilts on their balance sheet. But even then, that wasn't particularly exciting because they did roughly what the market expected. And I mean, it's meant to reduce pressure on the very far out maturities, so like 30-year gilt yields, 10-year gilt yields. Doesn't actually seem to have, because I guess the market had already priced in them cutting back on selling the longer dated gilts. So really, all round, sort of a damp squib, and really just points to what we've already been saying: kind of rubbishy labour market, rubbishy inflation figures. I mean, actually, it goes back. The next chief exec said something quite similar. He was saying, "I don't expect the UK economy to fall off a cliff, but I do expect anemic growth and this general sense of a lack of dynamism." And I think the Bank of England's kind of the dilemma is that it can't actually do anything about any of that.
As an aside, I think I'd ask everyone who hasn't yet to go and listen to our podcast with Professor Dieter Helm on energy costs. There's a lot of discussion in energy costs at the end of this week, because NVIDIA, the CEO of NVIDIA, pointing out that if we want to have an AI revolution in the UK, we're going to need to use an awful lot of gas, which doesn't fit into the UK's ideas at the moment. So it's worth listening to that podcast just to
a really good podcast.
It was. He's fantastic.
I caught
very
up
well
with it
explained.
Afterwards, and I thought that it's the first time that I've properly heard someone explain in normal human language what the actual problem is.
So it's important to listen to that one, and then to go back also and listen to the one we did a few months ago with Callum Pickering, where we talk about the effect that expensive energy really has on growth. These two things are so important at the moment as we languish around the place with rubbish employment, rubbish growth, highish inflation, and interest rates not quite where people would have liked them to be. I mean, I actually can't remember now, which is the way, of course, economists like it to be, but I can no longer remember what everyone was predicting interest rates in the UK would be at the moment this time last year.
It was definitely lower. It started with a 3 rather than a 4.
Yeah. And I will say, that we are planning, and this is very exciting for all of you listening, we are planning to start videoing our podcasts. And with that in mind, I have been tidying my bookshelf, shock horror. I know that no one who knows me well can really put the word tidying and Merryn in the same sentence. But along the way, I'm finding all sorts of fascinating books which are a reminder of just how many mistakes everybody makes all the time. So I've got, so 2 that I pulled out this morning. The Coming Collapse of China, written by Gordon G. Chang in 2012. Well done, Gordon. And then in the early 90s, Bill Emmett, the ex-editor of The Economist, Japan's Global Reach, all about the amazingness of Japan's multinational companies. That's not quite so idiotic.
When
obviously.
Was that published?
That was, I think, 1992.
Oh, fantastic. 2 years after the bubble had already exploded.
And of course, Japanese companies, many of them are still amazing, still with us, still huge multinationals, but obviously that was still a bubble book. So it's fascinating. And I'm looking out now, as should you be, John, for the book that's going to tell us that the AI bubble is bursting. It should come out just at the very top about how AI makes everything different, changes the world, etc., etc., etc. God, we're getting old. We're getting old. We've got to stop this. Right.
There's one just coming out. About
is that? Oh God!
Yeah, well, it's basically saying if anyone builds this, everyone will die. So, and that's quite a top of the market headline, I think.
It is, and that's exactly the kind of thing that makes me really glad that most books are wrong.
Yeah, well, yeah, exactly. I would prefer that is not the case.
Yeah. Okay, let's move ourselves over to talk about the Fed, which has actually managed to cut interest rates. So we now have divergent policies between the ECB, the Bank of England, and the Fed, which has now cut. Where are we now?
down to
4.25.
Yeah.
4.25%. So higher than us, but nonetheless coming down.
Yeah, I think the interesting thing is basically the Fed's got, I mean, obviously the US is a much better economy, but the Fed's kind of facing a similar issue to the Bank of England, and the inflation's still persistent, but employment looks wobbly. And so the kind of conversation around this cut was because some people had thought they could maybe go for a big 0.5 point cut, or they could even have possibly stayed flat, but most people expected the 0.25 point, and that's what we got. And the kind of conversation around it was not that different to the conversation here, which is, well, inflation's still kind of a bit too strong for comfort, but employment could go either way. And I think within that there was a lot of talk about whether political pressure would make the Fed act in a certain way, a more dovish way, obviously, because Trump would like them to cut interest rates. But it's not clear to me that that's actually had any effect. I mean, I think that in the absence of political pressure, they'd have done exactly the same thing. So at the moment, I feel that this idea that we're going to go back to a kind of 1970s Arthur Burns situation, getting bullied by Richard Nixon, it doesn't strike me as holding as much water as some people would like it to hold, but we'll see.
Okay, it's important to remember that the Fed do have more of a focus on employment than the Bank of England, so it is slightly different.
Yeah, and it's easier for them to rationalise rate cuts on that basis. But like I said, I don't think that's really anything to do with Donald Trump getting under Jerome Powell's skin. I think it's more about this is just what you would do in this situation. And we put too much stock in central banks' abilities to control the economy anyway, but that's a whole other podcast.
I'm looking forward to that one. When can we do that one? We spend a whole half hour complaining about central banks and central bankers and their God delusions.
We've never done that before.
Oh, we have it, actually. Anyway, John, I don't want to go on for too long because I know you're still recovering from your holidays. So we'll leave it there, and more on all of this next week. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Moses Andam. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.